Hello and welcome to Fidelity Connects. I'm Glenn Davidson. Fidelity's ClearPath target date funds are surging, and the way corporate plans are evolving could be shaping your clients' portfolios right now. And at the same time, what's happening inside institutional retirement plans is increasingly bleeding into advisor books, and it's something advisors need to be paying attention to. Our next guest says ClearPath is uniquely positioned at the center of that shift, bridging institutional strategies and advisor access. Joining me now to unpack what target date trends mean for your clients, how ClearPath is evolving, and how the portfolios are positioned today is institutional portfolio manager, Jon Knowles. Jon, wonderful to be here with you.
Yeah, great to be with you too, Glenn.
And a reminder, if you have any questions, please do send them in and I'll get them up here on the monitor. Jon, ClearPath, 21 years, I believe, this year.
Yeah.
It's amazing. Could you talk about your role, and then we'll get into ClearPath and how you work with institutional investors?
Yeah, absolutely. So I think a lot of people would look at my role and relate it to Alon Collette, similar teams, the Global Asset Allocation Group at Fidelity. We sit together in the Toronto office, similar title, but we operate in very different worlds. So just to give a brief summary of what I actually do, I'd say that most of my time is spent with two distinct groups in the institutional marketplace. The first of which is I spend a lot of times with companies around Canada of all sizes, big or small, and primarily I'm talking with their pension committees. This is a collection of individuals that are really focused on the pensions of these specific companies. They can be CEOs, CFOs, HR staffs, pension analysts, so on and so forth. So I'm spending a lot of time with them. I also spend almost an equal amount of time with consultants and advisors who are helping these companies make good decisions. You can think of them almost like a morning star, or if the advisors have a recommended list at their organization, there's a group that's focused on building that rec list. So there's a buy, sell, or hold rating on our ClearPath strategies as well. So those are kind of the two groups that I spend most of my time with. And it's interesting getting perspective from all these different folks. It's certainly a robust due diligence process that occurs, and the presentations can be lengthy, but it's great perspective that we get across the entire landscape of Canada.
So you cover the country, and you're
sure.
seeing all these massive companies.
Yeah.
We're going to dig into that during the next 25 minutes for sure, because you've garnered a lot of information that our financial advisor network is going to find interesting, but also ClearPath intimately, and you'll be able to talk about where it's come from, but also where it's going. But could I tell a story?
I'd love to hear a story, yeah.
So I go way back with Fidelity, and when I heard that I was going to do this with you and it was connected to ClearPath, I think the hairs on my arm stood up a little bit, because I have very, very fond memories of ClearPath. And I think, and if I could tell the story, it'll just set the scene, I think, hopefully a little better for what the solution is all about and what it's meant to the company. When I was a wholesaler in the mid-90s, and then we went through the tech wreck at the end of that decade, at the beginning of the 2000s, there was a real migration for advisors and their clients to go to fund-to-fund solutions.
Right.
And so for a few years, we just didn't have that solution at Fidelity, and some other companies did, either within their own dealers or some external companies. Yeah. And I was familiar with freedom funds in the United States because I was thinking, how do we get asset growth back at Fidelity? And freedom funds, if I recall correctly, in around 2004, were $30 billion US, and they were supplied through 401k plans. And they were fund-to-fund structures, but they evolved. I know you know all this, but I'm just thinking of all this stuff from the past. And I thought, if we could take that and put it into Canada, it would take the solutions that advisors were using at the time, but be the future, it would be the evolution of those solutions. Lo and behold, we eventually did and called them ClearPath. I think that was around 2005. Yeah. And that was a huge turning point for Fidelity. And it meant a lot. Advisors saw that as a migration. I saw planners and brokers alike using these solutions for different aspects of their clients' investing. But the autopilot component of it made advisors' businesses much more efficient as well. Yeah. So a very fond memory for me. So again, my recollection was freedom funds were about $30 billion. ClearPath just started around 2005. Where does all that sit today? And is freedom funds, are they even still in existence in the United States?
Yeah, I like where you're going with this. And as sort of students of the market, we all love living through history. So maybe just a brief reminder of some of the stats. So we've been managing target date funds out of the US through that Freedom franchise since 1996. So coming up on 3 decades. Where that franchise sits now, it was once $30 billion. it's coming up to $1 trillion in AUM.
Wow.
So it's a very large, important part of our organization's DNA now. And we've kind of been able to jump on that moving train in Canada. Certainly we have a smaller market here back home, but our ClearPath franchise, which is similar but importantly different to Freedom, is now sitting at around $33 billion. A lot of that is through the institutional channel, but we do have financial advisors that are certainly using it and finding it valuable for all of the reasons that you articulated back in 05, 06, 07.
So when we think about the way the solution is structured and what Freedom Funds were all about, ClearPath, when it came to Canada, was a retail solution that now has become a big institutional solution.
Yeah.
So ClearPath's actually, there's a bridge there for retail and institutional. And what we're going to learn from you today is a lot of what the institutional side is conveying and thinking about and also planning for.
Yeah.
So talk about it as that bridge between institutional and retail.
Yeah, I think there's a lot of important shared learnings in how these solutions are good fits for both everyday investors, but also through the workplace channel. And I think just an important maybe caveat or an interesting fact about ClearPath is that it's the largest institutional strategy that we have at Fidelity Canada that is also available to financial advisors. So we're very differentiated in the marketplace. There's a lot of target date providers now. It's become a large business, but almost all of them are singularly focused on the institutional marketplace, whereas we also own about 70% of the retail target date market as well. So we have a foot in both marketplaces. And we think that's important because the strategy is fundamentally great for Canadian investors, regardless of the channel through which they might access that.
Before we get into the trends that you're garnering from the conversations, I do recall when I would hear about Freedom Funds as a solution within a 401k plan in the United States, there was a lot of talk about the meetings that had to take place for due diligence, for companies to say, okay, we're going to make this commitment to use this Fidelity solution. There's a lot of concerns that companies have to make sure that there's no issues that come up for any of their employees. What are your meetings like? Are they like, they must put you through the ringer?
Yeah, so it all comes from a good place, but yes, we certainly get
true due diligence.
True due diligence for sure. The process, there's a lot of pre-meetings, and then usually there's sort of a final meeting that's typically called a finalist, where us and other target date managers will present in front of the pension committee, and we'll try and meet the specific needs and requirements that they're thinking about for their plan members. Ultimately, what they're trying to do with target date funds is provide a benefit for their employees. They want, as part of the total compensation package, the salary plus the benefits that you offer, and then importantly, the retirement component. That's really where ClearPath and other target date funds filter into the conversation for them. So it's very important in terms of the holistic compensation package that they're offering for their employees, and they want to make sure that they get it right. We have these conversations with them, and really what they're thinking about is we want to select a target date fund manager once and stay with them forever. That's what we want as a target date manager as well. We're thinking about a life cycle solution. Somebody buys it at 25, they retire, and they use it until they're 95. We want to be along that entire continuum for them. And a lot of companies are also thinking along that same line of thought.
And if I'm not wrong, the way it would work for the employee is when they have their group plan, it's option number 1, target date. Option number 2, and so on, is where you start to break things apart into tributaries, if you will. But that's at your own risk as an employee. But companies are making these target dates number 1, aren't they?
Yeah, and I think that's part of sort of the broader shift that we've seen from defined benefit plans to defined contribution plans. Really, the world I sit in is defined contribution plans. And what has happened is that employees, the onus on a good retirement experience has kind of been bestowed on the employee without them really having a vote or a say in that. Organizations have moved from DB to DC, and ultimately it matters the investment choices that you're making. And what companies are doing is they still want to ensure that people are set up for successful retirement just through this DC or defined contribution environment. So what that means is that target date is a great investment solution that ensures people are taken care of. We call it age-appropriate asset allocation. So regardless of the age that you're at or your years to retirement, you're going to have an investment portfolio that is right for you. And we call it set it and forget it, in that you don't have to do anything. You sign up. It's in that initial booklet that you get as an onboarding document. It's selected as the default investment option. And it really becomes the driving force of that retirement experience for individuals today.
And the idea is reduce that concentration risk. There was a time when people would only buy their own company's stock.
Yes.
There are some horror stories from that.
Yeah.
Great stories too, but a lot of horror stories.
Yeah.
And it's tough for someone to build their retirement nest egg and then see it disappear.
For
and
sure.
that's not the case with this. It's about, as our advisors are, I'm sure, thinking, it's all about KYC.
Yes.
It's understanding your clients and that diversity that they need for all the money that they've worked hard to make.
For sure. Yeah.
Over those years. Okay, let's get into the trends that you're seeing and hearing and through the discussions that you're having with the biggest companies in the country.
Yeah. So the very first and foremost, and this is a little self-serving here, I sit in a wonderful place. I'm very lucky. But target date is without any question the biggest trend that is occurring in the defined contribution space. Companies en masse are migrating towards towards target date funds, as that default investment option. So there's this great deal of inertia that is happening in the marketplace. That inertia comes from really two things, one of which is what's called auto-enrollment. So you fill out that booklet and the default option is going to be a target date fund. You can do some other investing as well, or you can complement a target date fund with other investments, but primarily people are set it and forget it. They're just defaulting into a target date fund. The other thing that is occurring is re-enrollment. And this is where a company says, we now want to offer target date funds, or we want to offer new target date funds. And they take all of their employee assets and they map them over to that new target date solution. So even if you had do-it-yourself products before, you are now invested in a target date fund, which is ultimately trying to produce better alignment for employees to ensure that they're invested in the right solution. And I think some people might look at that as being a risky endeavor, but there is a lot of academic research and a lot that's been published by Fidelity as a record keeper and record keepers in Canada that suggests that outcomes are better in target date funds. People have better returns because they're not transacting at the wrong time. Really, it's a packaged solution. It's a packaged solution that has delivered better performance year over year over year. That compounds really well. So just to give a couple of sort of stats or statistics behind this, now in Canada, as of the end of last year, we had 86% of companies were offering a target date fund, 67% of employees were using a target date fund, and 50 cents of every dollar in a defined contribution environment were going towards target date funds. So that kind of just gives you the size and scale that is now the target date industry, specifically in Canada. We got some catching up to do relative to the US, where it's $5 trillion, but you start a little slowly and then it compounds quickly. The next trend that I think is important is, as we talk about investor behavior, what employees are actually doing and contributing. So we typically see that savings rates are in the range of about 6 to 10% for sort of a median investor. It changes based off of your age range, but that's kind of the median that we're seeing. And the challenging thing, while that's good, and we've seen slight improvements over the years, is that inflation is really eroding some of that nominal. While the nominal savings are good, the real savings are not as good as we would hope from our sort of long-term retirement math. But what's good to see is that the regulators are actually trying to step in and counteract some of this to a certain extent. So this is still very early days, but the BC regulators have actually made a slight change to their pension rules, and they're implementing something that's called auto escalation. And what this means is that companies can now proactively increase the savings rates that are being pulled from somebody's paycheck to ensure that even in real terms, those savings rates are going higher over time. BC is the first to roll it out. It's coming later in 2026, but that's something that we think will have a cascading effect through the rest of Canada, where it hasn't been a feature. In the US, it's been a feature, and we've seen those higher savings rates. So we certainly know that it works. The last...
Oh, sorry, let me ask you about that. So it's proven in the US. Of all the provinces, one has stepped up and said, this makes sense, and the others are going, well, we'll have a look. Why do you think it is that only BC, good forward thought for them, but why is only one province on board at this point, considering it's also a proven methodology in the United States? Yeah,
sadly to say that this is kind of just a function of bureaucracy.
It is what it is.
It's a rule that you couldn't deduct more from somebody's paycheck. That was kind of just a governing rule that was in place. So you have to change the rules to enable this auto escalation feature. But once one does, you get fast followers. So we're optimistic that this will be a trend that continues into the future.
Makes sense.
We're monitoring it closely. But importantly, it's worth noting and flagging as a trend that could take hold. The last dynamic is one that I think is really important to financial advisors, and it's this degree of paternalism that we're starting to see through companies. What do I mean by paternalism? The historical model was, Glenn, you retire from Fidelity, you're a liability after retirement, get out of our plan, we don't care about you. Now it's, Glenn, you're retiring, oh, you have a lot of savings in your investment account, and you're actually among a cohort of individuals where all of the assets are. So by losing those large account balances, those companies lose negotiating power with some of their vendors, whether it's the investment manager or the record keeper or the benefits provider. So if their ultimate goal is to provide better benefits to their employees, that means all employees. And keeping the retiring cohort assets allows for better pricing for everybody else that's remaining in the plan. So there's a little bit more competition, I would say, that we're starting to see going forward, where companies are vying a little bit more to retain those assets, where previously that certainly wasn't the case, and they just wanted to be done with somebody once they retired. So I know financial advisors certainly do well with people that have just retired and they're leaving their plans. So that's a trend that's definitely worth monitoring.
So it's economies of scale.
For sure.
And it makes sense that they're saying, stay within these solutions, but we want to make sure they keep diversified.
All about economies of scale, for sure.
What are some other reasons? So advisors are listening to this today and they're saying, well, he's talking about group plans and 401ks in the States. But this is important information for them to understand what their client is going through their employer-sponsored plan, how that could parlay into what they're doing individually with that advisor, and what could happen upon retirement in the future. What are some other reasons why an advisor should really understand what's going on the institutional side?
Yeah, I think that's kind of the key link here, is that your clients have books of business with you, accounts with you, but they're also accumulating wealth through these other channels. And it's important to have an understanding of some of the dynamics that are playing out in these other channels. For example, in a prior world where we had people defaulting into money market, or they're extensively doing these do-it-yourself accounts, it's a little bit more challenging to manage as an advisor. What are they doing over there? What's their Canadian equity exposure, so on and so forth, and mapping that holistic picture. It's a little bit easier now, or we would hope it's a little bit easier, to have a sense that it's in a professionally managed target date fund that will de-risk as their risks and sensitivities change. So it's kind of trying to provide a little bit of that advisor model in that institutional environment, which hopefully should lead to better wealth accumulation. But increasingly, we're seeing this as a vehicle for that wealth accumulation for people to have better retirements. So it's an important trend to be aware of, for sure.
Well, and as an employee feels good about their retirement solution, and they understand that it's a target date solution and hopefully a Fidelity one, they're probably telling their friends and relatives. And that may then parlay into what the advisor is able to support them with financially as well.
And kind of an interesting sidebar is that when we're sitting in front of some of these pension committees, they do recognize that in many instances, people retire and go to a financial advisor and get that sort of more hand-holding decumulation experience. And one of the things that they appreciate is that ClearPath, not only available through institutional channels, but then they could also have that same offering available to them. So you continue that continuum of life cycle investing, both in institutional and then into the retail channel as well.
Let's talk about the mechanics of ClearPath. There's a lot of moving parts.
For sure.
My recollection is, because I haven't had to talk about them for quite a while, although fondly remembered, is that they are target date. So the asset mix when you're younger is more aggressive than it is as you approach retirement and go through retirement. And they evolve daily, I believe. Is it that frequent? But could you just remind our viewers, because there may be a couple of viewers that are saying, you know what, I don't remember what ClearPath's structure is all about. So could you talk about that?
So your memory's good. So I'd say
I appreciate hearing that, by the way.
We'll test you again next year and see if it's still the same. So there's two main components to our target date funds that we like to kind of parse out and talk about separately. The first of which is kind of what you were alluding to, is the strategic mix. This is essentially, we start with a blank sheet of paper and we want to build the investment portfolio that is good for the long term. So we're thinking over multiple decades, effectively aligned with that long-term retirement horizon that individuals have. So we're building the benchmark focused on things like equity and bond mix, but then also more detailed diversification. How much do we actually want within each of those components and what type of investments? To your point, we start with more equity for younger individuals, where our objective is really to try and grow wealth. And because they've got a lot of human capital and time on their side, they can sustain slightly higher volatility in those portfolios. As we get closer to retirement, we shift our goal a little bit and focus more on risk-adjusted returns, so more balance between stocks and bonds, and being much more diversified among that bond sleeve as well. And then we continue to de-risk well into retirement, where we focus more on capital preservation. And capital preservation in real terms, if you're retired and you're spending out of your portfolio, inflation has a lot of influence on you because your liabilities are going up. So the portfolio has to have some resiliency to it. So that's kind of the core or the anchor of the portfolio in the strategic mix. And then we also have active asset allocation and active management. Active asset allocation would be deviations from that mix, overweights and underweights to Canadian equities, US equities, commodities, all that fun stuff. And then also selecting the underlying portfolio managers that we believe can outperform in their respective markets, but doing so in a balanced and complementary way. We don't want to just have exposure to growth managers or just value managers. We want to have good, fulsome exposure that can operate well over a full market cycle.
Okay, so you talked about that asset mix, how it changes. It's more aggressive when someone's younger. It's more conservative when they're older. When this all came out in 2005, 2006, my recollection is it was equities and bonds. Is it still that clear cut, or is the fixed income component more diversified now into other asset classes? As Urian would talk about, that 40 is now split into 20 and 20 because there's other areas to go. Is ClearPath evolving, or is it stuck in the old ways?
Fortunately, it's not stuck in the old ways. That's one of the beautiful things about target date funds, is that every single day that we come in, we're trying to research and evolve the solutions into the future. And hopefully investors or people that are interested in ClearPath will really understand that you're not necessarily buying the solution as it stands today. You're buying how the solution is bound to evolve into the future. So really, when we talk with some of these institutions, they're testing us not on the portfolio today, but what is the research that's leading us to these specific portfolio composition today, so they can get a sense of, if things change in the future, how will we respond to that? And there's two primary dimensions of research that influence change. The first is what we see in Canadian investors themselves. What are we thinking about retirement expectations? How is retirement evolving? Government benefits, support programs, QPP, CPP, OAS, how does that factor in for retirement income? And then thinking very detailed on the capital markets side of things as well. So more recently, we made some strategic enhancements, so modifications to the benchmark. We announced this at the end of last year, but we've sort of been trading it over a couple of months here in 2026. There's two primary things that we're trying to achieve by this. The first of which is we want to better insulate the longevity risk for our investors. So for younger individuals and those further in retirement, we're increasing the equity exposure a little bit. For younger folks, 92% up to 96%. For older individuals, it's 21 up to 27. And then we're trying to refine the inflation resiliency. I think we've been leaders in the target date space in Canada in trying to infuse that inflation resiliency in our portfolios. We first did it back in 2018, where we added Canadian real return bonds. In 2022, we came back with global inflation protected bonds. And this year, we're slightly modifying the duration profile to reduce interest rate sensitivity. But then also we've added, sort of in partnership with David Wolf and David Tulk, actually, this interesting commodity futures vehicle that we've recently launched that gives us even more inflation resiliency in the portfolio. And we're adding it where it's most impactful to folks. Again, individuals who are older and really seeing those liabilities go up without that offsetting human capital that can also rise with inflation.
So would you, in your role, sit down with a corporation and their HR department, and it's the first meeting, you must be just waiting for that question about, well, Jon, how are you as a firm protecting against evolution of products and solutions, and also diversifying away from what were core assets in the past that we need to think about in the future? And you just wait for that question, and you've got a great answer for it. Is that something that comes up quite readily from these institutions that you're seeing?
Yeah, absolutely. And it's kind of that age-old question of, if you have a product, you're always worried about disruption, but we're constantly disrupting ourselves. And that constant evolution ensures that people are always kind of on the frontier of what we're thinking about in investing. But it's important to do this in the context of our investment process. So we're changing the strategic mix, which has a 10, 20, 40-year investment horizon, very long. So the things that influence this change occur slowly. So we're not changing the benchmark every single year. We just don't have the research that supports or gives us the evidence that says that this is actually going to improve outcomes. We make changes maybe every 3 to 5 years. That's our typical cadence. Spend a lot of time researching. The portfolio has been around for 2 decades. We've been managing target date for 3 decades, as I mentioned. So it's a high hurdle rate for us to make change in the portfolio because it really has to either improve the return potential or improve the risk profile, or hopefully does both so we can improve the risk-adjusted return of the portfolios.
We just have a few minutes left, and I'd be remiss if we didn't talk about where the portfolio's biased towards today, given the chaos of information, which is minute by minute, and the chaos of geopolitics, the chaos just of market moves, futures, and so on. I don't imagine ClearPath is making volatile changes, but there's got to be subtle adjustments that do allow for biases today. Could you talk about that?
Yeah, so moving from the strategic process that we were talking about to the active process, we're by no means day traders, but we do have that flexibility to take in the information that we see based off of valuations or some of the news flow. And just a sidebar, sometimes the best thing to do is just turn off your phone. But where we're positioned today is a reflection of our belief that we're kind of seeing both accelerations in growth, which is good, and accelerations in inflation, which is more challenging. So from a portfolio active positioning perspective, we're overweight equities with preference for non-US equities. So we're overweight Canada, ETH, and emerging markets. We're underweight fixed income because interest rates are challenged in this good growth and inflationary environment. We've talked a lot as a global asset allocation team about that positive correlation that currently exists between fixed income and equities, and that's more challenging for multi-asset portfolios. But importantly, we've been overweight commodities, which is a really good diversifier in this current environment. I think there's compelling reasons to own commodities just outright, but then they also give you that good layer of diversification. So that's a speed dating tour of our current positioning.
And a reminder to everybody, it's not that you are taking an active bet on commodities directly. You're actually looking at portfolio managers that have a bias towards commodities as the rounding out of that solution.
Yeah, so a bit of both actually. So as I was alluding to with David and David, we launched a new vehicle, which actually gives us exposure to the actual commodities themselves, but we've done it in a creative way. So this is a little bit geeky, so bear with me for a moment, but the term structure, you can invest in different types of commodity futures. The spot contract is the first one that moves the most, but what we're doing is we're investing a little bit further out the curve, which gives us slightly better return and risk profiles, but still assuming that same inflation resilient commodity exposure that we want. So we're getting a basket of commodities, energies, materials, agriculture, which gives us good exposure to some of the things that are ultimately inflationary in nature, but we're doing it in a slightly more creative way, which gives us a better risk-adjusted return profile than if we were just owning that spot contract that can be very volatile.
I had no idea, but that's why I ask questions and you answer them. This is really refreshing to hear that back in 2005, somebody that bought into ClearPath, which had a very traditional asset mix, can rest assured, or anybody that buys today, that it is evolving with the solutions that are available at Fidelity and in the market and in the world. And it's going to take them to a great spot for retirement and beyond. Could you just maybe close us out talking about, is ClearPath the only solution that an investor should have, or where does it complement their current mix?
Yeah, I think it depends on the ultimate investor. I think there's certainly individuals that can use it as a good core to their portfolio and then can complement with more Mark Schmale exposure or some additional exposure if they have specific themes that they want to lean into. I think where it's really become so important in the institutional world is this recognition that there's low engagement. So people don't want to be making these investment decisions, but companies want to offer a very well-diversified solution that is taken care of by these large global organizations that are well-resourced and researched. So it kind of can play in both of those worlds, but I'd say it's more dominated towards those that just do it for me, set it and forget it, and it will evolve over time, as you say.
Really interesting talking to you today, and interesting to hear what the largest firms in Canada are saying about target date solutions. And then I hope for our audience, seeing where there's a parallel to what the advisor is using and doing and expecting to hear from their clients as well as their clients learn more about the solutions that they're invested in. Jon Knowles, thanks so much for talking to me today.
Thanks for having me.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.